Good getting those details on PFC. Sanjay Parekh is with us, founder and CIO of Sohum Asset Managers. Sanjay, great to have you with us here. Thank you very much for your time.
Hi. How are you?
Hi, good to speak with you again. I just want to start with the one sector which everyone is kind of bullish on, and actually somebody messaged me out of the blue this morning, or maybe late night, saying that I am sick and tired of hearing that financials is the best place to be. He said it's coming out of my ears, not on television. I mean, he's on the in the equity side, and it is true, right? It is the consensus overweight, and why not? I mean, valuations, etc., are not cheap, but they're cheaper relative to many other sectors, and it's 30% of the Nifty weight.
Right.
What's holding it back? Or do you think this is just a routine period of underperformance, sideways action, and it's a matter of time before this space starts to fire up?
Yeah, Prashant, I mean, absolutely valid. So I just tell you our perspective. I mean, I've run the banking fund in Nippon earlier, and prior to that, even in ICICI, I looked at the sector for 20 years. So structurally, we all know that, the banking balance sheet is linked to corporate balance sheet, household balance sheet in a way, and also government balance sheet. And then, of course, RBI is also very important. Central bank is very important. And all of it is supportive to the banking sector. The asset quality piece, is at an all-time best level in the last 12, 13 years. The valuation, now that we have a clean book, the profits do matter. And if you look at price earning, it's 10, 12 times, 10 to 12 times the best of the banks. If you look at price to book also, they're very, very reasonable. And then you have leadership, established leadership, franchise, as I said, growth. NIMs were a little bit under pressure, but the growth has taken care of it. So overall, will they grow at 15, 20% in the next 3 years? Looks very, very reasonable. So I genuinely believe that, the largest PSU bank at today, we are looking at on FY25 is at 0.85 times. Or the largest private banks going through a merger is at 12 and a half times X of subsidiaries next year. So this, apart from COVID or 2008, for at least the private sector bank, I have never seen this sort of valuation. So when the lead large weights of the bank Nifty are available at such reasonable valuation, and then it's best to preempt a while. It takes a little bit of pain, and then the outperformance, it's not going to be linear. And we've seen that earlier, Prashant, Coal India or NTPC 2 years back was almost like a laggard and would not be following the radar of a lot of people, but you see the returns that has happened in the next 2 years. And I genuinely believe that the sector could be the same, where last 1 year has been weak, but the next 2 years, I think, will be really, really good for the financials.
All right. Hi, Sanjay. Thanks so much for joining and looking good in your Diwali attire as well. We'll catch up with you tomorrow in terms of the attire. But where do we find the next Coal India and NTPC? You've given us a hint with regard to the banking names. The largest private sector bank that's going to the merger, that will be HDFC Bank. And on the public sector side, the largest bank, obviously, SBI. But X of the banks, where do we find the next Coal India NTPC? It was a consensus, avoid. And suddenly, out of nowhere, it became a contra big hit. Your take?
Yeah, no. So, Nigel, a little bit on our strategy because it's relevant. So we not fixated that we are going to be hardcore growth investors or hardcore value investors. We are simple growth at reasonable price. And we're not fixated on this is quality, this is not quality. And, we are simply saying even a government company, which is reasonably fine, there are certain risks, but if they are the price value gap is larger and directionally things are better, we will look at it. So we had earlier Coal India, which we discussed, and that worked. NTPC also worked, though we couldn't buy in our portfolio. And now when I see today, we bought two names, which is HPCL and BPCL. And it is a contra, and that's why you need to have a calibrated weight. Now, what we are, we saw the numbers, and the first half itself, they've done 90 rupees earnings. based on the current price of crude, it can only get better, but it will not be, as much as 90. It could be around 120 if you had to get the current prices of crude at $70, $80 crude. Now, we all know that there is a regulatory risk. FY23 was not good and they had to bear the losses, which is a painful thing, and that is where the worry is. But what is priced in today, even if we take very reasonable, not even this year's numbers, we take $2.5 of net margins, we take $5 of GRMs for HPCL and $7 for BPCL, and the volume growth that they're going to get in the next 2 years, the benefits of the volume growth and the product upgradations and the marketing expansion advantage. When you look at them, they are going to be making 23 to 25,000 crore EBITDA. Now, you can't have HPCL at 40,000 crores market cap, which can potentially already has made 12,000 crore profit and could make 15, 16,000 crore profit. And they are almost at available at EV EBITDA of 2.5, 3 times on steady state numbers, not these extra advantageous gains that we had. So I think there is a case to be contra that looking at ahead in May, would this government again look at it with some stability in terms of the regime, and once that is through, on a base numbers also can they make significant returns? It's not for 15-20%. We're looking at significant returns. We've already invested earlier, and we genuinely believe there's a case to look at both of them, because the whole expansion they're doing now is not too much towards refinery. There is 20%, but the rest of it is towards marketing, EV, the whole of infrastructure on the marketing side, which will all benefit. So we believe there's a clear case of undervaluation, overly worrying on both the earnings and the PE side. And we believe both can get better and can be a big upside in the next 2 years. Having said that, it is risk on, if crude goes to 100, 110, obviously it's worrisome. We know the risk, and that's why you take the, calibrated bet.
Sure. So calculated risks, that's what it's all about in the market, I guess. By the way, a lot of wobble on the Ashok Leyland price. Let's just pull up the intraday chart, because first, when the numbers clash, top line is lower than expectations by about 200 odd crores, but the operating performance seems to be in place. Margins are kind of, along expected lines, and profit figure also slightly shy of the pole. So let's see where the stock stabilizes. It was suddenly down over 2%. Now it's trying to recover some ground. Sanjay, hi. Since we're on the subject, I just wanted to get your take on autos, because it's been a very divergent year for stocks. I mean, some names like Bajaj have done really well. Two-wheeler guys like Maruti and M&M, they performed well. But for Eicher, it's been a year of, dealing with heightened competition. Do you like this space at all? Would you play it, either auto or, the entire ancillary chain?
Yeah, so we are overweight on autos, and we've just added Eicher just for the disclosure purpose, and we have held Mahindra and Maruti for long. And of course, we have in the ancillary space, Samad and Motherson. So just on the, there are concerns that after the festive demand, there could be a lull for 1 or 2 months. But structurally, we believe that, they are really good long-term plays. We've been holding on this for, Eicher we've just added, but the rest of them, we've been holding it for now 1.5 years. As we believe that there could be a pause for a while, because there could be a slack demand in November and December. But we genuinely believe that, there's a clear structural story, in the four-wheeler space as well. And in case of Eicher, of course, the worry is extensive competition in the segment they are. And we believe that there will be some market share, they lose some market share in their category from 90 to maybe 75%. But very, very clearly, they were right to win, both in the domestic and export market. And they would have a host of products even to counter competition. So, and I think the whole category could also expand. So we do like it. And as I said, it's again one of the contra which has not been doing well for the last 1 year, but potentially can do well. And it's also corrected on valuation. So that's the rationale. So overall, we like the space. We have an overweight on auto ancillaries.
All right. Sanjay, we'll leave it there. Great conversation as always. Thank you very much. And, I couldn't, the camera is a little far away, so I couldn't make out what you were wearing. But this is indeed festive attire. And as Nigel said, we'll catch up with you, tomorrow. Tomorrow
Thank
onwards,
you.
I should say, all the way into Diwali. Thank you very much for joining.